So let's take a look at the business valuation resources tools that we have available in our courses. They're available through the Westminster Center for Financial Wellness, but heavily use them in a couple of our finance courses. The BV Resources tool includes Cost of Capital Professional, Deal Stats, and Guideline Public Company Comps. Cost of Capital Professional will help you estimate the weighted average cost of capital, either through the WACC equation itself using the CAPM structure for cost of equity, or through the build-up method. I'm going to spend a couple of minutes today helping you walk through the build-up method so you understand how to do this. In order to begin, we're going to need to look at the BV Resources website, which you have in some links in the Canvas course. I'll show you in a moment. But you can just find it through Googling BVR or My BVR. When you get there, there are 3 different logins available, and you can see them here on the screen. They're available through each of the 3 email addresses that I will sometimes use. And you'll notice that they each have the exact same password. That password changes at the end of each semester. It's probably not going to be all that surprising for you to be able to figure out how they change. Note that the reason we have 3 different logins is because only one person can be logged into the system under a login credential at one time. So if I happen to be logged in under the rhaskell@westminstercollege.edu login and someone else chooses to use that login, I won't immediately see that they're using it. But when I go to save my work, it may not allow me to do so. So be careful. There's not a good coordination system for this, but I would recommend that you use different logins at different times just to make sure. So let's go ahead and take a look at this. If you go to the bvresources.com website, we can go ahead and log in. And I've got my login credentials built into this, so I'll just go ahead and do that. And you'll see that we have these items to choose from. So we can see this either by going to the BV Resources tool, or by going to Canvas. And you'll see that for Canvas, for most of the courses, at least that I teach, that BV Resources subscriptions are found down here at the bottom. And if you click on this, it will go ahead and give you a brief description of what the tools are, how we're using them. Again, we see Deal Stats, Guideline Public Company Comps, and Cost of Capital. But you also see the logins again, and you'll see that I've given you a video to help you see how to use these. And I say I've given you, this actually is coming from BV Resources itself. This video that's connected right here, that's linked right here, is not one of my creation. You can also see videos for how to deal with deal stats as well. But let's walk through this particular tool and see how I use it as I put together the cost of capital for a business. So I'm going ahead and selecting the Cost of Capital Professional. And you'll see the first thing that comes up is this input screen in which we'll be able to give the company's name, the date of the valuation, and then we start to input some parameters for time. So I'm just going to use a company name. I'll say Almaden Technologies. I know as a drone manufacturing firm. That's not really its name, but it's one you'll see in some of the problem sets. And the valuation date, I'll just go ahead and select today's date. There's no relevance to this date other than what's going to show up on your report. The next 2 time parameters, though, there is some relevance to. We have to select the start year for our references and then the ending year. The relevance of the time parameter here is this sets up over what period of time are we able to collect data that will then go into our output panels. So in this case, we're going to want to use the longest period that we have available to us. I can either use the earliest year, which will give us the longest period available, or I can use some custom year. I like to use the longest period available because it irons out any anomalies in the market. I wouldn't want to use, for example, right now, 2020 as my reference or my earliest year because that was such an anomalous year. And I wouldn't want to go back into, say, 2007 because, again, that's going to reflect at the beginning of our sample the financial crisis. And similarly, I may not want 2001, and that's going to reflect the dot-com bubble burst. So I'm taking as long a period of time as I can here, which I think in this case is going to back all the way up to about 2020, or excuse me, back all the way up to about 1920. So I'll choose earliest year. And then for the reference year, literally always choose the most recent year, which is the default selection. I can either choose to use arithmetic means or geometric means. And those of you that understand means and the two terms will know that they're slightly different, but they're only slightly different in this case because we're using such a long period of time. And I virtually always use the arithmetic means. Notice that when I selected arithmetic mean, that it opened up this little set of inputs screens. And so we're going to go ahead and give information to each one of these input screens. The first one is RFR, or the risk-free rate. As you're thinking about this tool and its use, think about the cost of capital, calculating WACC, and think about how we go about calculating cost of equity. If we have all the right inputs to calculate cost of equity, or RE, through the CAPM equation, and you'll remember that CAPM is RF, or the risk-free rate, which is going to typically be a 2 or a 10-year treasury. And we then add that to the equity risk premium for that particular industry, which is RM minus RF. And RM in that case is the average rate of return for equities in that industry. So we will add RF to that term, and that will give us the rate of return that we should be able to expect if investing just generally in that industry. But we need to be able to have the rate of return of investing in a given common stock in that industry. So to do that, we're going to interact beta, or a statistical variance that helps us understand something about the price volatility of a company's stock. We're going to interact that with the equity risk premium for the industry. So we'll normally use the CAPM equation, or RF plus RM minus RF in parentheses times beta. Well, that only works if we have beta. And we only have beta if we have the opportunity to have observed the company's stock price over many periods of time. And that's probably not realistic unless it's publicly traded. And when we're doing the valuation work that we're doing, we're almost never working off of a publicly traded company. So in this case, we need to use the build-up method. So I want you to think about the CAPM equation as you know it to determine cost of equity, or RE, but we're going to come about the RE by a slightly different way using some similar terminology. So in this case, we're going to use the 10-year U.S. Treasury maturity, which as of today is 1.68%. We could choose the 20-year maturity, or we could use a custom rate. I'm not going to ever use a custom rate because of the way that I like to structure these. I might think about the use of a 20-year maturity if I know that this cost of equity is going to be supporting a holding that's going to be over an extended period of time. It's very difficult to know that, so I almost always just default to the 10-year. If I chose the custom rate instead, you'll notice that it deselected my initial selection. It lets me put in a rate, and then I have to explain why I used that. Well, if you're going to use any of the custom rate functions in this, or the custom input functions, you not only will give it the number you're looking for, and you'll see that this is repeated in some of these different tabs, but you need to give really good notes as to why. Those notes are going to show up in the report that is provided for us at the end of this, and will be a guide to help you back to figure out what you did and why you did it. Well, in this case, I'm going to go ahead and use the 10-year maturity. Next tab is for the equity risk premium. And the equity risk premium in this case is going to be for investing in equities generally. So this will cover the entirety of the equities market. The CAPM construction that we're familiar with uses RM minus RF as the equity risk premium for that particular industry, not the market as a whole. But here this tool is beginning at the very bottom by looking at the risk-free rate, which is the amount that we should be able to get just because we put our money out there for investment, period, without any real risk associated with it. And then it's going to start to layer on different elements, and it's going to build up a cost of equity rate for us. So in this case, I'm looking at this, and I have two choices. I can look at the country-specific risk profiles and the equity risk premium, or I can look at Dr. de Motoren's equity risk premium. And because I am an admitted acolyte of Oswath de Motoren, I'm going to use his numbers. And I will use, in this case, the historical equity risk premium for the period that we've chosen. It's the longest period of time. In this case, it's 1928 all the way through 2020. And it happens to be at 6.43% right now. I could have chosen one of these other two inputs, but those are only for 2020. And just as we said at the beginning of this, I like a longer time period. Again, I could go ahead and choose a customized number. I'm not going to do that only because I don't want to sit here and think that I can outsmart this system. I can give it inputs that are more complex. I'm trying to be fairly consistent here and without a lot of extra detailing. Well, the next one is for the size premium. And we don't see size premium specifically in cost of equity, but it's in there. And it's in there separate from the risk-free rate, separate from the RM or market rate, separate from the equity risk premium for the industry or the risk premium for the market as a whole, but it may have something to do with our company itself. So as we start to look at these kinds of numbers that are embedded in the size premium now, we're starting to look at something that is specific to our company. Well, you can see here that it gives us some deciles. So everything from the largest decile in the market down to the smallest, and then it'll give us some combinations of deciles, the first and second, third and fifth, sixth through eighth, etc., or first through fifth, or sixth through 10th. This tells us the number of companies in the sampling, so the count, and then the size columns give us the size of the company in revenues each year, but these are in the thousands. So here where this says 29,025,803, it's really 29,025,803,000. So these numbers are in thousands. The returns are relative, of course, because they're just ratios. And in this case, I'm looking at a firm, Almaden Technologies. The current revenues are less than $4,500,000 in a year. So I'm going to choose the smallest. I might choose 9 and 10 combined right here if I thought it was somewhere between 2,200,000 and 451 million. But in this case, it certainly is between those numbers, but that's a big spread. In fact, in my case, it's certainly less than $189 million. So I'm going to just choose the smallest. Now I'll move on to the industry risk premium. And this is going to give us a little bit more about the industry as a whole. Again, it's for the same time period, but now we're being given some industry-specific parameters. Well, I can use the Salvideo and Partners data that's available through this tool, which is just a data repository, or I can use de Motoren. And again, I'm going to choose to use de Motoren. When I do that, it brings up the ability to search industries by some keywords. So I'm going to just go ahead and say technology. Try to spell it right. I get drugs tech, I get healthcare and technology, healthcare information and technology. I don't really like that. I'm going to go ahead and put manufacturing. And it doesn't give me any real choices. So I'm going to come back and look at something else. And so I've got a lot of choices. One is in the renewable energy space because they're highly dependent upon the use of batteries and renewable energy. I'm going to choose that instead of health information and technology. So again, it's given me the indication of the beta factor for firms in that industry. we're looking at 0.98. Now it's compared to the market, and the market would have 1. In this case, we're looking at the part of the market. It's giving us out of the 25 firms we've looked at, it's giving us 0.98. And I'm going to go ahead and use that. I don't feel the need to put in a customized rate. But it gave us an industry risk premium implied at about 0.13%, so less than 1%. So as I look at this now, I can go ahead and look at the cost of equity. And I can either do it through the build-up system, or I can do it through the capital asset pricing model, or the CAPM model. I'm doing it through the build-up method. If I chose to, I could use capital asset pricing, but I have to think about what the beta is. And in this case, I don't want to do that. I want the system to do it for me. And so I'm allowing that to take place. But notice some of the inputs here. We selected in our initial screen, this RFR screen, we selected this 1.68, and we see it reflected for us right here. In the ERP screen, we selected the 6.43%, and it's showing it to us right here. In the size premium, we selected 7.83% based upon the size of the company, and it's showing it to us right here. We now have the ability to input 1 or 2 other possible figures that'll be used in this whole build-up system. The one is the unsystematic risk premium, or a risk premium that we might build into this cost of equity because it's something that's completely outside of the firm's control, but is inherent in the industry that the firm is in. Well, I'm not going to do that at this point. I don't have any good reason to do that. I haven't talked with you enough about information about the company or its industry or the economy to make that selection. But if I knew some things, I might put them in here. But these are unsystematic. These are not specific to the company itself. Might be to the industry, certainly is to the market, but not the company itself. If I want to use then an industry risk premium that is custom, that is specific just to the industry, not to the market as a whole, I can go ahead and customize that. I've already given it one, but I can go ahead and use another. I can do that. I've already selected an industry beta based upon my selection of firms under IRP. But now I want to think about, is there anything more? And I can use the company-specific risk premium as something more. So think about this. Almaden Technologies may have a management grouping that's not all that sophisticated, maybe even not all that experienced. Or maybe they have had some financial difficulties in their past that they're still recovering from. And either of those would warrant a higher beta than maybe other firms in the industry. Or just the opposite. We might be dealing with a firm with a very stable management, a firm with lots of equity capital, a firm with very little downside volatility, in which case we might put in a lower company-specific risk premium. Well, I happen to know enough to remember that we put in a size premium of 7.83%. That's already going to take care of some of the volatility that we might expect to see because of the size of the company. And I know that the management is kind of cutting edge. They tend to be fairly aggressive. So I'm going to give it, in this case, an extra 5% for a company-specific risk premium. This is a judgment call. You're not going to find any tables that tell you exactly how to do this. This is kind of a judgment call, as I said, based on intuition, based on experience. Well, as I've done that, notice that this now is implying a 20.81% equity risk, or cost of equity, or RE. We want to now think about how that fits into the WACC equation. We can do that. But to do that, we need to help this system understand the percentage of the company's capital structure that's found in equity versus a percentage in debt. And then we're going to use that cost of equity. We'll use the debt rate, or the current borrowing rate on debt. That would be RD. Think of it as current yield. We'll look at the tax rate, and that's going to give us then the cost of equity using a build-up method. And here what we've got is the WACC equation. So in doing this, I first have to think, how do I find the company's cost of equity using this structure? Well, we found the equity cost here, but now I want to apply it in the WACC equation. And to do that, I have to know what my weights are. And in this case, I'm going to first try to identify the equity percentage or the equity weight. And to do that, I need to know something about the value of the asset, because in order to know the value of the equity and the weight of the equity, I need to know the value of the whole asset. So I must have to use some kind of a tool other than just the WACC equation itself, other than the balance sheet, to be able to figure out the equity percentages. And I have to use a tool that's not reliant on a discount rate, because we're in the process of putting together a discount rate. So in this case, I'm going to go ahead and use some other non-market or a non-discount rate centric tool. It's not going to be a DCF of any kind. We're not going to discount it all. And the only one that I can think of is I can either use the asset approach or I can use a market approach. And so that's what I'll do. And I'll consider then the total value of the company as some metric that's based upon an enterprise multiple. And let's say that the enterprise multiple I'm looking at here is EBIT, an EBIT multiple. So it's going to be EBIT divided by enterprise value equals some multiple. And let's assume in this case that multiple is 10, and let's further assume that the EBIT is $1 million. I'm just using numbers here. It doesn't really make a lot of difference. I just want you to understand how we're going about putting this together. Well, in this case, if I say that the EBIT's $1 million and the EBIT multiple is 6, that would mean that the enterprise value or the value of the asset is $6 million. Fine. Now, still, we don't have the percentage of that that's equity. But if I can now go ahead and subtract from that the value of the debt, I am left with the value of the equity. And if I know the value of the equity divided by the value of the entire asset, then I know what my percentages are here. So let's just assume for a moment that the debt has a $1.5 million amount. We already identified that what we had, it was a $6 million overall value for the asset. And so we can take that debt divided by the overall value, or D divided by V, or 1.5 divided by 6, and we get 25%. Well, if 25% is the weight of the debt, then we must have 75% as the weight of the equity. So I'm going to put in 75%. And notice that immediately it gives me then 25% as the weight of the debt. It also gives me an opportunity to put in some notes. So I'm going to say that we used an EBIT multiple of 6 times 2020 EBIT to establish the weight, and that we used the debt from the balance sheet at 1.5 million. And that gave me enough information now that I am able to figure out how I did what I did if I ever need to go back and look at this, or if somebody else needs to look at it for me. Well, the next thing we need to do is look at the borrowing rate. And again, this is a number that you might have difficulty just finding, but you can either understand it by intuition, or you can observe other firms in markets or other market transactions. And so there's some experience that's necessary here. I happen to know that the current cost of borrowing for a good credit quality firm that's in an up and coming space is about 5.25%. And I happen to know that if we're looking at business tax rates for a year after 2018, that we're going to be looking at 21% federal and 6% state, or 5% state, excuse me. So that's going to give us a 26% tax rate. And if I put those into the WACC equation with my weights, my cost of equity, costs of debt, and tax rate, I know that I've got a discount rate, or WACC, at 16.58%. The final item here is in the summary. And literally the summary just puts this into a report for us. Notice that when it did so, it used some of my text that I put into that custom field. I can either go ahead and just select and paste all of this. So select, copy, and paste this, or I can click on copy and it'll do the same thing. Or I can go ahead and download all of this. So if I download all of this into an Excel file, it takes just a moment, and then I can click on the file. And I'm now looking at an Excel file with a couple of different tabs or worksheets, and that just give us information about what we're doing, and then the summary itself. And we can save this, we can copy and paste it to other items, or we've already copied the item from the report here. And now I have finished my utility of this tool. So I hope that this is going to help you a little bit as you fulfill some of the assignments in the different classes that you have. Please feel free to let me know if you have any questions. Thanks.